Hey, Dan Passarelli here. One of the most challenging things about understanding options is understanding volatility. Volatility is a little bit esoteric to option trading, and it gets confusing because there's two different types, implied volatility and historical volatility, and they're easily confused. This video explains the difference between the two. So historical volatility is simply how much the underlying stock has moved around lately. And if we look at this chart of the S&P 500, the blue line is historical volatility. That just talks about how big the magnitude of moves have been lately. Implied volatility, which is represented by the red line here, is how expensive or cheap the options are. Now that might seem a little bit strange, but if you think about the fact that people buy and sell options based on their expectations for volatility, right? If you think that the market's going to be more volatile, you're more likely to buy puts to hedge or buy calls or puts or straddles to speculate. Now, there are a few things that are involved in the analysis of both implied and historical volatility. And one is how today's implied volatility relates to today's historical volatility. If we look at the S&P 500 here and we look at today's implied volatility, it's above today's historical. This is one indication, not the be-all end-all, but it's one indication that implied volatility is expensive. And that means options are expensive and better to sell. If we look at DoorDash, we get just the opposite. We see that implied volatility is below today's historical volatility. So that's an indication that maybe, just maybe, options are cheap and they're better to buy. And then, of course, if they're equal to each other, like here in Ford, then that could be one indication that implied volatility is fairly priced and neither buying nor selling options offers an edge. This is Dan Passarelli, Trade Smart.